Hello there, and welcome to our latest episode of the Market Misbehavior podcast. I'm your host, Dave Keller, a founder of Market Misbehavior and the president and chief strategist of Sierra Alpha Research. I'm so glad you're joining me on this latest episode of the podcast. We're almost 40 episodes in, and it's been such a pleasure to interview top market practitioners, traders, brokers, analysts, strategists, money managers, authors, educators, anyone we can get a microphone in front of to talk about market conditions, what tools and techniques they are using to analyze these market conditions and anticipate what may be coming next, or navigate the changing market conditions in a volatile 2024 to 2025. Also, just some of the lessons learned in their experiences analyzing and trading the markets over the years. Today we have a fantastic guest, Craig Johnson. Craig is the chief market technician at Piper Sandler, based in Minneapolis. And a little bit of technical analysis history. You may or may not know that Minnesota is probably, in my opinion, the third biggest technical analysis sort of enclave or hotbed after New York and Boston. New York, of course, all the big brokers, and in sort of the peak of the big sell-side technical research departments in the 1970s and 80s, all the New York firms had huge technical research departments. Boston, of course, which is where I was at earlier in my career, big buy-side shops like Fidelity, Wellington, Putnam at times had pretty capable technical research departments. But Minneapolis probably tied with Florida for the third place one. And in Minnesota, you had people like Steve Leuthold, Ed Nikoski, who were at a firm called Piper Jaffray. It actually had another name which Craig mentioned in our conversation. I forget what it was already, but I thought of it as Piper Jaffray. That's when I was first introduced to it in the early 2000s. Not now called Piper Sandler, but a lot of those guys had a start and really helped build out a fantastic technical research department at Piper Jaffray. Now Piper Sandler, that Craig continues to drive that legacy forward, but there are a number of smaller technical research firms based in the Minneapolis area, all driven, all starting from that Piper team back in the day. We've had some others on this on our podcast. Doug Ramsey, the chief strategist and investment officer at Leuthold Group, was on the podcast a couple weeks ago. Jeff Hughes, who's a big Elliottian, big Elliott wave expert. We've not had him on yet, I don't believe, but I might fix that here in the near future. So getting into my conversation with Craig, again, I've known Craig for a number of years. We actually served on the board of the MTA, now the CMT Association, together. He was actually the president right after I was. I stepped down in 2014. He took over then, and so we served on the board of that organization together for a number of years, and really enjoyed his work. And when, in my Fidelity days, got his research every month. And so we talk about the book that he produces to this day every month, and it's fantastic. I mean, it was a read you would look forward to. It really just had so much data about sectors and about seasonality and about tendencies, right? What tends to happen when these different configurations are present, and here's what we think that means about the current markets. They have a proprietary sort of sector and industry classification called the microgroup strategy, which really goes to very granular groups of stocks and really thinking about strength across those different groups and themes over time. A moving average based strategy where he would bucket stocks into different things, I think called the MACE strategy, which he talks about in our interview. Obviously an interesting time to talk to someone like Craig. The markets have been pretty challenging so far. We recorded this sort of late March of 2025 when the S&P already down quite a bit, 10+% off of the February high, bouncing and testing its 200-day moving average. And that was the moment where when I sit down with Craig and start talking about how to think of this. He had some really good comments, I think, about recognizing the difference between short-term pullbacks, short-term corrective periods, and long-term uptrends. He points out, which is absolutely true, when conditions get rough, when it feels like everything's not working, that's usually the time when you want to start thinking about buying, particularly if you have a long enough runway, right? If you have a long enough, forward time frame to deal with, when the market corrects, that's usually when you can get great companies at a discount. And so we talked about that sort of way of thinking of corrective moves, how it could provide a good opportunity here in 2025. I loved his quote, "Swift corrections lead to swift recoveries." I asked him about that quote, and I thought his comment about potential V bottoms was really good. We talked about small caps. We talked about seasonality in post-election years. Talked about some of the bombed out sentiment indicators like the AAII survey recently printing some of its most bearish readings in history. Talked about non-U.S. markets versus U.S. markets. He was a little less interested in non-U.S. and thought that the U.S. market may be ready to catch up, which I thought was interesting. And then we focused on risks that are out there in the market, opportunities going into Q2, how to play this type of environment, and which areas of the market were starting to show renewed strength. So a fun conversation with really one of the top technical analysts in the industry. He's consistently up there, ranked by institutional investors in their annual survey, and wish him, of course, as always, the very best and much success at Piper Sandler. So please enjoy this recent conversation with Craig Johnson, the Chief Market Technician at Piper Sandler. So super excited to sit down with Craig Johnson of Piper Sandler. Craig, it's been a while. How have you been? How's the new year? How are things your way?
Dave, the new year's been good, except for this market volatility that we've had in here. It's certainly causing some concern with a lot of investors, both individual investors as well as institutions. But I got to tell you, a little volatility sort of makes life kind of exciting.
Bull markets are boring, I guess, right? Is another way to maybe the corollary to what you just said. I would
You
agree.
know,
Bear markets are where things kind of get interesting. It feels like there's stuff to pay attention to, signals to filter through, and all of that. So
too, Dave, when we have this sort of volatility in the market, I seem to have a lot more friends, a lot more people call. What's going on? How are things? And then they kind of slide into the conversation like,
oh,
hey, what do you think about the market in here? Should I be buying? Should I be selling? And I'm kind of like, hey, when I asked you to file my taxes last year, I didn't get any sort of discount or free advice from you. So, that's
You're
kind of how it
you're
works.
everyone's best friend at the moment, Craig. That's a good thing, I guess.
It
So
is.
so we're getting to the end of the first quarter. Obviously, Q1 of 2025 has been very different than, most of 2024.
Mhm.
Rotation of leadership, changes in most technical tools that you and I would follow. What stands out to you as like the defining shifts? Like, I mean, what changed the most that tells you early 2025 has been very different than 2024? What are those key things that stand out to you, sort of laying out this rotation?
Well, I don't know if a lot has changed, Dave, and that's kind of
Okay.
been part of the message that I've been trying to lay out for people because
Yeah.
I feel like we're sort of marching through the madness at this point in time. And while your bracket might be busted here, Dave, I'm not sure that the bracket is busted for this bull market that
Love it.
started in October of 22.
Yeah.
And the reason I say that is I went back and I did kind of a quick dive into this market, and I was looking at from the highs of the market for the S&P on 1219 to the lows we did on 313. I pulled out what were the 25 worst performing stocks, like which ones went down the most. And I
Okay.
went through and I pulled that whole list together, and I was looking at it. I'm like, technology, consumer cyclicals, technology, services, technology. And I went through that list. And then once we hit that sort of inflection point low, which I do think, Dave, legitimately is an intermediate term low for this market, I looked at what stocks have now bounced the most as we've been sort of coming off those lows. And the
Mm.
interesting thing is 40% of the worst performers are now on the best performer list for those top 25. So what I'm saying is it hasn't really changed. Technology had been the leadership. I think technology still is the leadership. It looks like what happened in this market has been something of a volatility, beta, and short interest kind of puke that took place. And as I think a lot of institutions were sort of reducing their book or degrossing, as they call it, and that's kind of now done and passed. And we're going to be wrapping up this first quarter. I think we're going to be setting ourselves up for probably a more positive second quarter going forward because, again, I don't think leadership has changed. And then, Dave, if you take it one step further and you just go back and you draw a very simple uptrend off of the lows of 2022, and
Mhm.
you sort of draw your long term trend up, and it's like we haven't broken an uptrend technically for the S&P or these markets. So I guess my point is a lot of volatility, a lot of noise, but I think the trend of this bull market is still intact.
It's interesting. One of the things, and I appreciate you sharing your most recent monthly piece, the monthly book. I remember getting every month. It was something I look forward to reviewing. One of the quotes from that was, "Swift corrections lead to swift recoveries." We've
Mhm,
certainly seen what appears to be sort of a V bottom, right, going into the March low, coming out of it.
mhm.
Is your sort of assumption that this is the beginning of that recovery phase, and we continue on? I know you have I think an S&P target like 6,600 ish for year end. Is this the
Yeah,
beginning of that swift recovery, do you think?
I think I think it's I think the intermediate term low has been made to be precise.
Okay.
I also think that um, based upon the analysis that you're referring to, which is our S&P 500 corrections, duration, and recovery table, where we went back and we looked at the duration, we looked at how long it took to get into correction territory. And Dave,
Mhm.
this was the sixth fastest decline into correction post World War II. And if you look back at the speed of this, and to answer your question specifically, I do think that again, intermediate term low is in. We're starting to work our way higher. And if I use history as a guide here, based upon that analysis and table, I would tell you that we're probably at a new high by the end of May if history
Mm,
repeats itself.
interesting. So the question, of course, goes back to what are the types of things that sort of lead the way higher. One of the themes you addressed in most recently is small caps, particularly when you think of the seasonality post election year, or what you call an inauguration year.
Mhm.
Small caps tend to do pretty well. We've continued to see small caps kind of lagging here. Is there
Mhm.
a point where small caps start to re-exert a leadership role, and what would you look for to sort of validate that potential outcome?
Yeah, I do think that we will start to see this pick up in small caps.
Yeah.
Again, sort of going back to history. And Dave, as you know, I love looking at market history, studies, and in these sort of choppy, really uncertain times, I sort of come back and say, history, again, may not repeat, but if it rhymes, we got
Mhm.
something that may look similar to this if these sort of items line up and they're somewhat similar because fear and greed doesn't change. Period.
Mhm.
As I look through the market and looking at these charts and studies help me put this into perspective. And what I'll be looking for this recovery is specifically looking at the Russell 2000 to see if we get a sustainable move off of these lows. I'll be watching breadth of the market picking up. I'll be watching specifically new highs, new lows to see if this is sort of confirming. And then I'll be going back and as I go through with our kind of weekly chart books and stuff we put out, Dave, I'll be going back and saying, a lot of these names have corrected materially, and a lot of them have come back to big identifiable support on weekly charts. And I'll be looking for those support levels to hold, is what I'll be specifically looking for, and then starting to rally off of it from here. That's what I'll be specifically looking for. And to your question just a moment ago, we've got a 6,600 year end objective. There is no question in my mind that that is a very good objective built up on a bottoms up point and figure analysis that we've done for years. And I certainly stand behind that number right now.
Mm. And I feel like most times when I talk to you, we talk about objectives. I have to remind everyone, you and your sales team produce these fantastic CJ2K shirts. When we were thinking about the absolutely unrealistic idea that the S&P could actually break above 2000, and it's become one of those like foundational moments when I look back at my career, is just how the levels change. You just have to keep up with it. You mentioned breadth, Craig, and I'd love to know. I mean, there's a lot of breadth indicators that I talk about on my show, and that others follow. Are there sort of general breadth measures that you tend to follow? Are there proprietary breadth measures in the Piper Sandler library that you found most relevant? Like when you talk about breadth improving, what specific charts would you look for to sort of confirm that improvement?
Yeah, Dave. So one of our go-to indicators that we look at is what we call our 40-week technique. And again,
Okay.
that's one of the things that was developed years and years ago by one of the great technicians, Steve Luthold. He had
Yeah.
put that together when he worked here at Piper uh, Jaffrey back then and Hopwood, and now it's Piper Sandler. So what I've noticed with that particular breath indicator is when we've studied it over time and it gets down to levels where less than 20% of stocks are in any form, or excuse me, 20% of stocks are still above their 40-week moving average. Again, I like to look at weekly versus daily to try to smooth out some of the noise. But when you get down to those kind of levels, Dave, you're getting to points in time where you often form V bottoms and you get recoveries. And it sort of tells me that a lot of the negative news has been already priced into the market. And that's one of the things that I'll be going to. It's a very broad indicator because we're looking at a little over 4,000 stocks with that particular 40-week technique. And it's around 406 different industry groups that we've got wrapped up in all that thing in 12 economic sectors. So that's usually a good starting spot for me. And then after that, I like to try to layer on other things, kind of create the mosaic, putting it together. Like, where's sentiment at? Okay, breath is washed out. Okay, sentiment's washed out, and kind of keep going. And then other indicators that I'll look at will be like our 26-week new highs indicator and lows indicator on a 10-week moving basis. And then we'll also go back and look at what we call MACE. And that's where I use a very simple crossover system of 4, 13, 26-week crossovers and sort of measure how many stocks are in uptrends, how many stocks are downtrends. And it's a pretty good clue when you start getting down to kind of 20% or 10% of all those stocks being in any form of an uptrend. You probably would throw out the phrase at that point in time, Dave, one doesn't get hurt falling out of basement windows.
Quote of the day so far, Craig. The day's not over, but that's pretty good. I like that one a lot. Those are awesome. And again, I remember the MACE work. It's all about moving average crossovers and bucketing stocks based on their moving average configurations. And particularly you see when there's a rotation, you can kind of just see groups rotating from one bucket to the next. And I always found that super valuable. You mentioned some of the bombed out sentiment. I know in your latest report, you highlighted the AAII survey. I mean, arguably at one of the most bearish readings you'll ever see. I mean, it's down to like 50, 60% bearish or something like that. What is that? What does that very negative sentiment tell you about an outlook looking forward? I mean, how does that fit into this overall mosaic of a corrective period and a potential bounce?
Yeah, so take that particular gauge, Dave, and when you look at this and you go back and you say, let's take the delta, the spread between the bull and the bear index. Like right now, it's negative 40. And when I go back in history, and again, use it as a guide, and that's what I think I can't stress enough to your listeners is don't get emotional about this market. Step back, look at history, put this all into perspective. And when you do, you start to say, wow, this is kind of overdone. Because when you look back and you say, I've got bull bear readings right now with the AAI that are at levels we only have seen at the lows of the market in 22, the lows of the markets we've seen in the great financial crisis. That's where we are right now. And we're expecting this market to get worse, to get negative. Psychology is pretty bombed out at this point in time. And when I've seen these readings sub 40 like we have right now, what if I told you, Dave, that 4 weeks after such a reading, you were higher, the markets were higher, being the S&P, 70% of the time with an average return of 2.6%. 8 weeks later, you were higher, again, 70% of the time, but 4.57%. And if you're thinking out 26 weeks later or half a year later, you were higher 90% of the time with a median return, okay, of 15%. Wow. The average return was 14.43. So when you start looking at this, you're like, you keep thinking about Warren Buffett, right? You need to be greedy when people are fearful and fearful when people are greedy. And right now, this sort of looks like a run-of-the-mill correction over tariff concerns and fears, which again are valid. But at the end of the day, if you think about all this sentiment out here, it's overdone, it's overblown. And the media right now is sort of, well, accentuating some of these concerns. And again, people are sort of putting some sort of political lens over their portfolio, which they shouldn't be doing. They should be stepping back, being objective about what the charts, the trends, sentiment are telling us right now. And I think that's a little bit missed. And Dave, if I could, one other sort of piece that we put together for this month's publication, which I think is pretty interesting and telling. We went back and again, we looked at every single stock above, in this particular case, a $5 billion market cap, broke it up into 3 buckets, 5 to 20, 20 to 80, and then greater than 80. And then I went and did a quick BQL search, if you remember those days, Dave, on Bloomberg. And I said, what percent of the stocks in those buckets are 20% or more below their 2024 highs? And the 5 to 20 bucket, 41% of all the stocks. In the 20 to 80 billion bucket, almost 30% of the stocks. And in the greater than 80 billion bucket, it's about 23% of the stocks. So if you think about the about 1,300, 1,400 stocks that were included in that analysis, Dave, you sort of come to the conclusion that a third, roughly a third of the market is already in a bear market. And then come back to history. And you remember, like, this is not the great financial crisis. This is not one of these things. Credit spreads are not blowing out, financials are not rolling over. Those are sort of the telltale signs that things get worse. That's not happening today. So, what I'm saying is, I think we have the Mag 7, which really accentuated the market on the way up, can't really compress in terms of multiples further here. And you've already done a lot of damage underneath the surface. And the bull bear spread kind of picks up on that. The 40-week picks up on that. The new highs picks up on that, and all these things. And again, we're supposed to be buying stocks when they're on sale, not paying full price for them. And right now, stocks are clearly on sale.
It's funny when you think of it that way, and I love your point at the end there, Craig. And I remember, I mean, just from my days working at a large money manager, I mean, portfolio managers would be thrilled with this kind of environment because it was an opportunity to buy great companies at a discount. You basically have like a 20% off coupon on Nvidia. It's like, that's awesome. I mean, why not? And also 100% of market corrections have been fully recovered from, right? I mean, the market's made
Yeah.
new highs after every correction. So if your runway's long enough, I mean, it makes a ton of sense to start looking for opportunities. Another area that you teased out most recently that we've been talking a lot about is just non-US markets, right? So
Mhm.
2024, it was sort of a very clear US over non-US, no questions asked. US was dominating. I mean, with some random exceptions like India at times, but overall US was the place to be. 2025 very different, right? Developed European markets, France, Germany, Switzerland, even like Italy making new highs while the S&P's kind of been trending down. If
Mhm.
we do get that kind of recovery with the US market starting to improve, does that non-US outperformance start to be brought into question? Or do you think, I know a lot of individual investors in particular are sort of, not playing, ex-US markets just because the returns have not been there. Should we continue to focus for opportunities outside the US and yes or no? Why or why not?
Yeah, I think we're going to have to be careful thinking about continuing to invest internationally.
Yeah.
Despite all these tariffs, okay, I don't think that the world order has changed.
Mm.
Okay, the world order has been the US innovates, China replicates, and Europe regulates. And I don't think that that world order has changed despite the tariffs, any way you cut it. And one of the things that we've done is we've created a very simple kind of analysis looking at the MSCI All World Index XUS and sort of compared that to the S&P 500 on an annual basis. And one of the things that we sort of interestingly found is uh, that from the great financial crisis till today, there's only been, basically excluding this year, two other times since that 2008 2009 period of time where the MSCI World Country Index XUS has outperformed the S&P 500 on an annual basis. Before that, Dave, we found that things like the tech bubble led to some outperformance of the MSCI All World over the S&P 500. We also found that the Plaza Accord and the trade deficit concerns back in the 1980s led to a period of time for about 4 years that we did see international outperform. But at this point in time, I don't think the odds favor trying to go further into the European markets because, again, I think a lot has changed since the 80s. And the new world order is what I said earlier, which is US innovates, China replicates, and Europe regulates. And until that changes, I think people are going to be interested in putting their money in the safest spot that they can, which is still the US, and where you've got the best and most innovative growth and tech companies located.
No, well said. I love that summary of the global environment. That's
Mhm.
awesome, Craig. All right, so let's get maybe to perhaps the most important question. I know a lot of investors are thinking about now that we're wrapping Q1, we're going into Q2, we're getting into another earnings season, and more Fed meetings and all of that. If you think of the U.S. market in kind of three general buckets, kind of the growth trade, a lot of those names obviously have come down pretty much off of their like January, February highs, and potentially starting to rebound. You've got the value sectors like financials and others, which have actually emerged kind of strong. But then defensive sectors like utilities have actually been pretty good year to date as well. Looking forward to Q2, like what stands out as some of those emerging leaders where you would think are good opportunities to consider?
Yeah, so let's break that sort of break that down.
Yeah,
If we think about the large cap versus small cap, it's still leaning toward large cap at this point in time. If we think
okay.
about growth versus value, it is definitely we've seen the uptrend off of about the 22 lows, sort of violated, leaning more toward the value side. But Dave, the speed at which this shift has taken place has been substantial. And when I look back in history, when you've had such a quick shift, it has historically not really been sustainable, that move toward value from the growth names. And if you think about the Mag 7 stocks at this point in time, and you actually think about that as the growthier areas of the market, the multiple and the valuation on those things have been uh, compressed enough that you're at one of the cheapest periods of time for those kind of stocks. And my view is that those names are ultimately, as you head into Q2, are probably still going to be laggards in the market. I didn't say down, I said laggards, meaning that on a relative basis, they're probably not going to be leadership, probably end up consolidating sideways. So, what I think you'll end up starting to see unfold as you go through earnings season is a calming tone from these companies saying, yeah, there's uncertainty, but business is still okay. And you don't really see projections and numbers really getting lowered at that point in time. And I think you'll see these growth stocks start to come back, but it won't be necessarily the Mag 7. It'll be things below the surface that will certainly be stronger. Could be stocks on the software side like Snow or Monday.com or some of those kind of names, which could certainly be stronger from that perspective. And I also do think that we will see the small cap stocks really pick up. It's going to be more about the 493 versus the 504 with the S&P 500. So skipping out those other companies from that perspective. That's where I think the action is going to be. And then keep a solid eye on financials because at this point in time, the yield curve is normalized. I think the expectation is with inflation coming down, when you're looking at CPI, you're looking at PPI, it really suggests to me that the inflation battle is kind of sort of been won. And if the jobs numbers keep slipping like we have been seeing over the last couple months in here, I think the Fed is going to be in a position where it'll be comfortable to say, we're going to lower rates maybe another 25 or 50 basis points this year, which I think will ultimately be very positive for mid and small cap stocks. And that's where I'd sort of be positioned. Use this opportunity, this pullback, to buy some of these really beaten up small mid cap stocks. Because I showed you earlier, Dave, you've got 40% of those names that are in bear market territory right now. And that's probably not really going to be sustained for the full year.
Great take there all around, Craig. And I appreciate you talking about sort of those opportunities outside the Magnificent Seven. I feel like so many people are still sort of mentally thinking of those as areas of strength. A lot of names out there with potential. Maybe charts would be a great way. We probably both agree to identify some of those emerging leaders. Craig, great to chat with you. Thanks for joining us from Minneapolis, and we'll talk to you again soon. Hopefully later this year. Okay.
Thanks, Dave. Thanks for having me on anytime.
So it's a great conversation with Craig Johnson. Again, he's one of the best really at the top of our industry in terms of sell-side technical analysts, people really whose job it is to help institutional investors improve their returns using technical analysis. You know, we mentioned a number of times the monthly book. He, very kindly sent the most recent monthly book ahead of time so I could review it. And it's really only for institutional investors primarily. And it was a lot of fun to, dig through and remember some of the great, the rich data and analysis that's part of that monthly exercise that he and his team put together. I really appreciated his comments about, short-term versus long-term. And I feel like in a correction like we seem to be in of some sort, right? Some corrective move that could be over or could certainly be deeper. Craig was pretty confident that we've sort of seen the low, or sort of like, we've already established it, and maybe we don't get much lower than that. Talked about his year-end target, but I think, just staying, having an appropriate long-term perspective during corrective moves, I think, is a brilliant way of approaching this sort of particular environment. I really liked some of his comments. As you could probably tell, he does a really good job of saying, all right, here's what's happening with the AAII survey today. Here's what's happened the last 30 times we've gotten down to this particular level. Here's the average return 3 months out, 6 months out, 12 months out. And that sort of analysis is super valuable, because so often we get caught up with the narrative. All right, sentiment is bearish and that's bad. And we just sort of generally think that means the market's going to go down forever because of that, as an example. What Craig and others like him do is do a brilliant job of actually showing, all right, well, this is what usually happens when the indicator gets to this particular level, looking at mean returns, median returns, the outlier returns, and just really thinking about what tends to happen if you can look forward 6, 12 plus months after some of these signals. And that is really a very intellectually honest way in terms of, and a very logical way of analyzing market conditions, which I think is really well done. Hope you enjoyed that interview with Craig Johnson. As always, we're really excited to get your ideas about who else we should interview, who else should be on our list of podcast interviewees. Make sure you drop a comment wherever you're watching or listening to the podcast, and let me know. By the way, if some of the tools and techniques we talked about in terms of analyzing market conditions, looking at breadth and sentiment and price action, and trying to understand market dynamics and anticipate what could come next, if you want to be able to analyze the markets a little more effectively in your own process, our Market Misbehavior premium memberships may be a really good option for you. 3 great benefits to the premium membership. Number 1, you'll have access to all our virtual courses. Flight School Behavioral Investing is our first course that we always encourage people to start with. Talks about behavioral finance, what happens between our ears, and technical analysis, which is a set of tools to understand the world around us, improve our market awareness. There are other courses that we're always adding, and you'll have access to all of them as soon as they come out. Second benefit, you have access to our members-only reports. Our weekly flight plan is our main report. We put it out every weekend. We reflect on what we learned in the week that just happened. We look forward at the week to come. What levels, signals, and patterns are we on the look for? Also, our monthly chart review, where we unleash our proprietary market trend model on a series of different asset classes and ETFs to really define the changing trends in the markets and looking for new opportunities. Finally, you have access to our members-only community. It is an active, thriving community of like-minded investors, sharing insights, sharing trades, sharing comments, asking questions. I'm in there every morning answering questions. Just this morning, I was in there answering a question from a premium member about gold versus gold stocks, copper versus copper miners, thinking about different ways of looking at commodities versus some of their related equities. So I have access to all of that from day one. Should be a great a tool and resource to help you navigate these markets. If you want to learn more, you can find all the information, all the benefits, the pricing, and everything else at marketmisbehavior.com/premium, or just scan the QR code that you see if you're watching the video. That's it for today. Thanks so much for joining me here on the Market Misbehavior podcast. My name's Dave Keller, and remember, it's always a good time to own good charts.